All right, let's talk Summit Hotel Properties, ticker INN. We're breaking down their Q2 2025 earnings call. And wow, what a quarter! It was a really fascinating, kind of conflicted story, you know? You had this great financial management on one side, clashing with some pretty tough headwinds on the other. So let's get right into it. So, right off the bat, this is the core puzzle. On one hand, Summit missed analyst expectations on standard GAAP earnings per share. But then you look at adjusted funds from operations, which, let's be honest, is the number REIT investors really care about, and they actually posted a slight beat. So what gives? Was this a good quarter or a bad one? That is exactly the question we are here to unpack. Here's our game plan for this explainer. We're going to hit the headline numbers that caused all that confusion, then look at the operational story. After that, we'll break down management's financial strategy, see what it all means for their future guidance, and then we'll wrap it all up with our trade idea for the next earnings call.
Okay, let's start with those top-line numbers because this is really where all the concern began.
The key performance metrics for any hotel operator, well, they were kind of flashing red. Revenue per available room, or RevPAR, was down 3.6%, and that was mostly driven by a 3.3% drop in the average daily rate they could charge. Now, occupancy held up okay, but the big picture, it really points to a softer operating environment and travelers being much more sensitive to price. But, and this is where it gets really interesting, look at this contrast. Even with all those industry-wide headwinds, Summit actually outperformed its direct competitors. Their RevPAR index, which basically measures them against their peers, grew by 150 basis points to 115%. What does that mean? It means in a shrinking market, they were grabbing a bigger slice of the pie. That's a huge win.
So let's see how this all feeds into the bigger operational story. And really, it's a classic case of just really strong execution in a super challenging environment. Management was super clear on the call about what they were up against. First, the comparisons to last year were just brutal. They were going up against huge one-off events like the solar eclipse and the NCAA Final Fours. On top of that, demand from government clients just fell off a cliff. We're talking down over 20%, and international travel was still pretty weak.
And this is a perfect illustration of their response. They just buckled down and focused on what they could actually control. They kept a super tight lid on costs. Year-to-date operating expenses were only up 1.5%. They managed to cut back on expensive contract labor. And, like we just saw, they fought tooth and nail for market share, pushing that RevPAR index to a new post-pandemic high.
So the really crucial point here is how they paired all that operational discipline with a really smart financial strategy. The goal was pretty clear: build a balance sheet that could weather any storm, a real fortress.
On the call, they talked about two major refinancing moves. And the result? It's powerful. Summit now has 0 significant debt maturities until 2028. Think about that. That gives them a huge amount of financial flexibility and a very, very long runway to navigate whatever the economy throws at them. And with that stability, here's what they're doing with their capital. First, they saw the stock was weak, so they jumped on it, repurchasing 3.6 million shares at what they called an accretive price. Second, and this is smart, they're funding these buybacks by selling off non-core assets. It's a self-funding strategy. And third, they held the line on their quarterly dividend, which is always a signal of confidence to shareholders.
Now, it's not just about buybacks and dividends. Their strategy also includes investing in these high-return growth assets. And the prime example is their unique Onera Fredericksburg property down in Texas. Get this. Before its recent expansion, this place was pulling in an incredible RevPAR of about $360.
And here's where your jaw kind of drops. That super high RevPAR translates into a hotel EBITDA margin of nearly 50%. 50! So by putting capital here, they've basically created this high-growth, high-profitability engine that's completely different from their normal hotel portfolio. It's a really key part of their story. Okay, so let's piece this all together and look to the future. We got to dig into management's revised guidance and see how the market is thinking about the stock right now. Management was pretty blunt about it. The CEO, John Stanner, basically acknowledged the softness and said that full-year results are now tracking modestly below the low end of their previous guidance. So they're officially resetting expectations lower for the rest of the year. No sugarcoating it. You can imagine this has left investors in a wait-and-see mode. The sentiment is definitely cautious, maybe neutral at best. Everyone's impressed with the balance sheet work and the cost control for sure, but that good stuff is being directly offset by the obvious weakness in the revenue trends right now. So let's put it all together. What's the actionable thesis? What are we looking for heading into the next earnings report? This is the million-dollar question, right? For any analyst or investor looking at this stock, where does it go from here? The argument is just so perfectly balanced. I mean, the bull case is clear. You've got that fortress balance sheet, excellent cost control, they're gaining market share, and they have that gem of a growth asset in Onera. But the bear case is just as clear. Weakening RevPAR, margin pressure, all the macro uncertainty, and of course, that lowered guidance. So here's our prediction for the next call. We expect Q3 results to land right around management's new cautious guidance, probably a RevPAR decline of about 3%. Because of that, we see the stock as range-bound. It's likely just going to trade sideways until there's a clear positive catalyst from the broader economy. And for that reason, we are assigning a rating of market perform. And that brings us to the final thesis here. Summit Hotel Properties is a defensive hold. Management is doing an absolutely masterful job of navigating a soft market. They are controlling costs, shoring up the balance sheet, doing everything right. But the stock itself? It likely needs a bigger, broader recovery in travel demand before it can really start to outperform. So the key question for investors is simply this: will that recovery get here in time to reward all their discipline? And just a reminder, this presentation is for informational purposes only and is not financial advice.